Good day everyone. Today we're going to learn about cost of capital. The objectives of this lesson are to explain the definition of cost of capital, the source of cost of capital, the computation of a specific cost of capitals, and the computation of weighted average cost of capital. So what is cost of capital? It is the rate of return the firm expects to earn from its investment in order to increase the value of the firm in the marketplace. In other words, it is the rate of return that the suppliers of capital require as compensation for their contribution of capital. According to J.C. Van Horn, cost of capital is a cut-off rate for the allocation of capital to investment of projects. It is the rate of return on a project that will leave unchanged the market price of the stock. According to Lawrence J. Gitman, the cost of capital is the rate of return a firm must earn on its investments for the market value of the firm to remain unchanged. It can also be thought of as the rate of return required by the market suppliers of capital in order to attract needed financing at a reasonable price. So we have the sources of cost of capital. We have the equity share. Equity share is the money owned by the company or the main source of finance for any business or company. Second is the preference share capital. These are share of company stock with dividends that are paid out to shareholders before stock dividends are issued. Is debts. These are capital borrowed from banks and other financial institutions or issuing bonds. This is obtained through private or government sources. The fourth one is retained earnings. So retained earnings are the amount of net income left over for the business after it has paid out dividends to its shareholders. So we have the first type of cost of capital, the cost of debts. It is the cost of using banks or financial institutions' money in the business. The banks are compensated in the form of interest on their capital. So it is the minimum rate that debt holder will accept for the risk taken. Cost of debt is the effective interest rate that company pays on its current liabilities to the creditor and the debt holders. Generally, it is referred to after-tax cost of debts and the before-tax cost of debts. So now let us proceed to the computation of the specific cost of capital. We have the cost of debts. So here is the formula. Cost of debts is equal to interest expense times 1 minus tax rate. We have here an example 1. A company named Vist took loan of $200,000 from a bank at the rate of interest of 8% to issue a company bond of $200,000 based on the loan amount and rate of interest. Interest expense will be $16,000 and the tax rate is 30%. So we can calculate this using the formula. Cost of debt is equal to interest expense minus 1 times tax rate. Our interest expense is $16,000 as you can see from the problem. So our tax rate is 30%. So let us simplify. So 16,000 times 0.7. So our cost of debt is $11,200. Let us proceed to example number 2. Suppose a company named Arts PV Ltd. that has taken a loan from a bank of $10 million for business expansion at a rate of interest of 8% and the tax rate is 20%. Since interest expense is not given, so let us first find the interest expense. So we have here the formula. So interest expense is equal to loan amount times rate of interest. So the loan amount is $10 million, as you can see from the given, from the problem. So times 8% the rate of interest. So our interest expense is $800,000. So now since we have find the interest expense, let us proceed to the computation of cost of debts. So cost of debts is equal to interest expense times 1 minus tax rate. Our interest expense is $800,000 times 1 minus 20%. The 20% is the tax rate. So let us simplify. $800,000 times 0.80. So here the cost of debts is $640,000. So now let us proceed to the after-tax cost of debt. So we have here the formula in getting the after-tax cost of debts. Cost of debts times 1 minus tax rate. So we are going to use this for this the example number 3. Suppose a company named AIM Marketing has taken a loan for business expansion of $500,000 at the rate of interest of 8%. The tax rate applicable was 30%. Here we have to calculate after-tax cost of debts. First, we have to calculate the interest expense. So the loan amount times rate of interest. The loan amount is $500,000 times 8%. So our interest expense is $40,000. Let us proceed to the cost of debts. So our cost of debts is equal to interest expense, which is $40,000 times 1.1 minus 30%, which is the tax rate. So let us simplify. 40,000 times 0.70. So the cost of debts is $28,000. So continuation. After tax, after tax cost of debts is calculated, so we're going to use this formula. After tax cost of debts is equal to cost of debts times 1 minus tax rate. The cost of debts is $28,000 times 1 minus 30%. So let us simplify. $28,000 times 0.70. Now we get after tax cost of debts, which is $19,600.